Hey folks, Joe Valley here. Welcome to another episode of the Quiet Light Podcast. In this episode, we're talking to Juan Garcia from Bupos.com. That's Boopos.com. They're an alternative lending source for buyers of online businesses, mostly e-commerce and SaaS, and they're just getting into content a little bit. Juan and I chatted for about 30 minutes talking about who qualifies, how to qualify. In some situations, Quiet Light's pre-qualifying them. We have closed 2 or 3 transactions using Bupos. The buyers technically used Bupos to close the transactions. And sometimes we're putting pre-qualified, alternative funding pre-qualified up on the listing. And you'll see that in the teaser. If it says funding available, but it's not SBA, it's probably someone like Bupos that can provide the funding. We go into a number of things in terms of obviously what the cost of this funding is compared to SBA, the term of it, and talk about the fact that you can refinance it a couple of years with an SBA loan and get a lower interest rate and a longer term, 10 years compared to 5, which would shrink depending upon the growth of the company and how quickly it's paid off. We also go into the details of how it's paid off. It's actually tied to revenue, not profit or anything like that. And the nice thing about this type of funding with Bupos compared to SBA is there's no personal guarantee. So a lot of good stuff covered here. We also talked to Juan about his entrepreneurial journey a little bit. You know, this is a company that he founded in October of 2020, and he's got a long history of entrepreneurship in investment banking and also a startup company that's similar to Uber over in Spain. So it's a great interview, and it's a great source of funding for buyers that don't have all of the lending that they need. They've got some cash. And we go into how much cash you need compared to how much you can get from Bupos as well. So let's get to it. Here we go. Hey, Juan, welcome to the Quiet Light Podcast.
Hey, Joe. Great to be here today with you.
It's good to be here. You know, your name has been bouncing around the Quiet Light team because you guys have helped with some funding for some of the transactions. And we'll get into that a bit. But before we do, can you give the audience a little bit about what you do, who you are, what company you run, that kind of stuff?
Sure. Yeah. So we are an acquisition financing lender. We've been in the space for the last couple of years. But essentially, we help people acquire businesses by funding up to 80% of an acquisition. We take a royalty cut, so it's revenue-based financing. We get repaid over the course of 5 years, and we're very quick. We base our underwriting on data, and usually what is on the Quiet Light files is good enough for us to underwrite. And we take no personal guarantees, which is super important for many buyers that just don't want to kind of put their assets at risk.
So the URL, folks, it's Bupos, Boopos.com. It's funding for acquisition, but your website says it's also funding for growth as well for existing e-commerce owners. Is that right?
That's correct. But our core product is M&A financing. We, in many instances, businesses that we have funded for an acquisition deal need extra working capital financing. And that's why we offer that type of product. But it's kind of very uncommon for us to do that if it's not in connection with an M&A loan.
Okay. So folks, you guys have been asking for acquisition financing other than SBA, and here it is. Let's talk about the size deals that you do, Juan. What's the smallest you've ever done? What's the largest you've ever done? And what's the largest you ever want to do?
Yeah, we start at 100K, so pretty small, and we can go up to 2 million right now. So we are increasing our size, our maximum size as time passes and our portfolio gets more diversified. And right now, yeah, we can do up to 2 million. I guess that our sweet spot is probably in the 1 million-ish range. That's where we stand.
Okay, and so if I wanted to buy an e-commerce business and I brought $500,000 to the table, can I get the other half from you?
Indeed, yes. So we require the buyer to fund 25% of the amount that we lend. That's our only requirement. And then you can take more, less, depending on your needs.
So if you're lending 100, I need to bring 25 to the table.
Correct. Yeah.
Okay. So for $1 million, I need to bring 250. Does that mean the purchase price would be 1.25 million in this situation?
1.25, or it could be even higher if you use a seller note, because sometimes sellers help with that.
Yeah. So folks, I that's exactly what I was just going to say. Oftentimes there's a mix of seller notes in there, and the easiest seller note possible if you've got a e-commerce business is a short seller note on the inventory, because you're going to have to come up with the next couple of 100,000 or more on inventory. Just do a short seller note on that, and it's going to help you acquire the business with much less cash down, let's say. So what type of businesses have you guys financed so far, Juan?
We do 3 verticals: Amazon businesses, especially FBA. We do e-commerce like Shopify, D2C stores, and also subscription-based businesses, which tend to be SaaS software businesses with sticky client base. That's something that we look into when financing this type of business.
So why only those? Why not content sites, for instance?
And that's a good question. We're actually exploring content. We've closed like one loan recently that was for acquiring a content site. We are still, I guess that's still experimental, because we need to get comfortable. The way we underwrite businesses, we look at a lot into their operational metrics, which is super important for us, as well as financials, of course. And so whenever we start a new vertical, we have to make sure that we're very comfortable with what we're lending on. So content sites are something that we are starting to kind of understand.
Cool. Well, we love content sites quietly, along with everything else, but we're starting to see more and more come listed. A couple of the advisors have really honed in on that particular niche. So you started this a couple of years ago. You're not from the US, you're over in Spain, right?
We are a US company. It's just that a part of the team is based in Spain. I myself, I'm Spanish, and it happens to be that around 1/3 of the employees are based in Spain. Okay.
And how long does it take to get from, we've got a buyer out in the audience, they find a listing that they like. At what point do they reach out to Bupos in order to get approval?
So I guess there are 2 entry points. One of them is we typically pre-approve a big number of deals. So we look at the Quiet Light marketplace or other marketplaces out there, and deals that we feel there's a fit within our underwriting model, we pre-approve them. So that's one entry point. Buyers that just found a business that was already pre-approved. And then sometimes they will just send deals to us via our app. So it's the point in time where people come to us is usually when they're exploring, they have a number of options, they have some ideas, and it's helpful for them to understand how we work and how we can help them acquire these businesses. And then over time, they will end up closing an LOI, and that kind of triggers the closing process with us.
So if you look at the Quiet Light listings, folks, you're going to see, we try to make it as easy as possible to make your search a little quicker. And we're always going to put a headline on the teaser. If there's nothing about financing, there is no financing available that we know of from sources like SBA and Bupos. If it says SBA pre-qualified, obviously that's SBA. If it says alternate funding or some other funding besides SBA, that's probably a firm like Bupos. So as you look at our particular listings, you can distinguish between cash requirements, SBA financing, and alternative funding from a company like Bupos. Typically, what kind of credit ratings, things of this nature, does a buyer need to have or experience? For instance, I once had an SBA deal turned down because the two friends, were getting lending from their parents for the cash down, and the rest was going to be SBA. They were 2 Harvard MBA students. They had just graduated, but they didn't have any work history. Does that matter to you from your perspective in terms of funding a buyer?
It's in a way it does. So basically, we underwrite the deal on one side, and we look at profitability, how much money it's spending in advertising, whether the business is growing, etc. We look at the operational metrics, and that's on the deal side. But then we have to underwrite the buyer. the way we underwrite the buyer, we don't look at the credit score or the credit history, but we do look at their track record in managing this type of business or the type of business that they want to acquire, their track record in owning businesses in general or acquiring businesses. That's something that's important for us. Now, the particular case that you're mentioning, we would have to look into it, but we have like an interview with every buyer, and we make sure that we're partnering with the right people and at least people with the right experience for acquiring the business and the right motivations plan. So, for example, in the case of these students, if they have a very clear plan of what they want to do with the asset that they're after, if they have a strategy, a due diligence plan, and a very clear idea of how to manage the business, when there may be an opportunity to get funding with us. But obviously, not having a track record is penalizing for us.
And how do you have the conversation? Is it a telephone call, Zoom call, a survey that they have to fill out? How's that work?
Yeah, it's a video call.
Video call. Cool. Do you investigate them prior to the video call? Like, do you check their LinkedIn profile, Instagram feed, Facebook, that kind of thing? Or is that not as important to you?
It's, we usually get all the info that we need from the video call. And of course, we ask them for permission to take a look at their LinkedIn profile, etc. By the way, we usually interact a lot with buyers before closing a deal. So that's also a good kind of learning process for both them and us to kind of get acquainted before closing a deal together. Because in the end, we're partnering, we're going to be partnered for the next 5 years. And that's good, not only for us, but also for them.
Why 5 years?
5 years is our typical payback time.
Okay. You mentioned, well, let me ask first, during that buying process where you're really getting to know the buyer, and this is our situation too, we're really, getting to know our sellers over the process of the valuation and looking at their P&Ls and understanding them to the point where, we just know if they're lying to us or not, right? And of course, we look at their profiles and things of that nature, and we have their financial records. So we do get to know them as well. But at any point in your situation, like a few times in ours over the last 15 years, we've had to say, this person is lying to me. This person is full of it. We can't take them on. We're not going to work with them. We're going to pull the listing, things of that nature. Have you ever been in that situation where you're, halfway through the process and a light bulb goes off and things are not adding up and you say this buyer's not legit?
Yes. And we learned a lot about that. So for example, when before closing, we will always ask for a proof of funds to make sure that they have the equity that they have to invest. Mm-hmm. And we warn them beforehand. Like, we tell buyers before sending an LOI, you have to make sure that you have the equity for closing this deal. Because if you don't have it, then you won't close with us, and we will request a proof of funds. So that's a learning that we have through the process, because in some instances, people try to get to the finish line without having enough funds to kind of figure out a way to closing. And that's something that we cannot do. We just cannot do it.
Yeah, if you do that, folks, you're going to burn the bridge with the a brokerage firm as well. Whether it's Quiet Light, FE, Empire, website closure, whoever it is, you're going to burn that bridge. And we all have systems to, make comments on any particular buyers, and we're going to be like, this person faked their way under LOI. We'd ask for proof of funds before going under LOI as well, Juan. But if they lied and cheated and then they ended up not having the money, they get sort of a black mark on their profile. You mentioned due diligence in there a little bit. A lot of folks, we recommend companies like Centurica. I had Nate on the new owner of Centurica on the podcast a couple of weeks ago. Even though we're on the sell side, we really, really think it's important to hire a professional due diligence firm to help you vet the numbers and everything else. Do you require that on your side, or do you have a team that helps you with that, or what do you do in that situation?
We don't specifically require that a third-party advisor carries out a due diligence. By the way, the Centurica guys are pretty good at it, and we saw reports from them, and that's it gives you a lot of peace of mind. But in many instances, we partner with people who have a lot of experience in e-commerce, and why would we push them into hiring someone for doing the job? So we just want to make sure that the buyer performs a due diligence, either with a third party or themselves. And our due diligence is probably much lighter. We just make sure that the numbers that we use for underwriting are correct. And we rely on operational matters on the buyer.
Gotcha. Okay. Before we get into the cost of this type of lending, can you give folks, a little background on the company? It's been around for a couple of years. Are you one of the original founders? Are you an employee? What's the situation there? How did you raise capital? You're an entrepreneurial success story as well. So let's just hear a little bit about that. Then we'll get into the final details on what kind of cost is associated with this lending.
Sure. Yes, I founded the company back in 2020. I was the CFO of a company called Cabify, which is like Uber for Spain in Latin America. And before that, I was an engineer. I worked in private equity. I'm kind of a finance guy and a tech guy at the same time. And I learned about aggregators. I got super excited. I wanted to jump into the space. And then in the end, I realized that there was a big pain for many buyers in terms of obtaining reasonable funding. And that's kind of how it all started. I guess that, in the beginning, actually, I interacted with Quiet Light Moral as a buyer. And a part of our underwriting models stem from that original stage. Then we did kind of a proof of concept with a small portfolio of around 5 loans with our own equity. And then we raised money from VCs. We are backed by a big UK fund called Fasanara. So it's like a huge 3 billion assets under management company. And that's the money that we are deploying now.
Gotcha. Okay. Very exciting. Very cool. So it hasn't been that long. It's been a couple of years. You launched it post-pandemic after March 20?
Yeah, actually, I started the business in October 2020.
Okay. So about 8 months later. Okay. You just used the term reasonable funding. So how does it work? Yeah, I'm in need of $1 million. I've got 250 of my own. How much am I going to pay? And do people refinance as quickly as they can? Is there a penalty for paying down early? Give me some of the skinny there.
Sure. So there's a market out there of people who just don't want SBA because of the personal guarantees, or they cannot access SBA because they just don't qualify because they're not US residents, or because they don't qualify because the business doesn't qualify.
Exactly. I was just going to add that it could be the business doesn't qualify. Yeah.
Or because SBA is being slow. So we're very quick and we can help people acquire a business. And then over time you can refinance with SBA, which is
okay. That's interesting. Well, only if you're a US resident, but yeah. Slow. So SBA folks are going to take, 45 to 90 days, and usually it's usually longer than shorter. So in some situations, a cash buyer that's a good person, likable, and is kind and professional to the seller is going to win if the SBA buyer is the exact same wonderful person, but it's going to take 2.5 months to close versus a cash buyer that can do it in 30 days. Cash buyer is going to win. In this situation, Juan, you're going to be pretty close to that equivalent of that cash buyer.
That's exactly how it works. So those are the main advantages versus an SBA loan. What it means is that we're taking a higher risk than SBA because we're taking no personal guarantees. We're also making sure that the money is available very quick, and that obviously has a price. So we're taking a 15% annual return. So if you repay within 1 year, you will be repaying 115% of the amount that we lend. And then that increases over time. So if you repay on the second year, that will be 1.3 times the amount that we lend, 1.45 and 1.60, and that's our maximum cap. So that's the typical or a rough estimate of what the cost is. So
it caps out at 1.6 if it's a 5-year loan.
Mm-hmm. That's correct.
Is it gets to 5 years? Yeah. Okay. That, in the short run, it's perfect, right? It's alternative funding, non-SBA, quick closing, compete with cash buyers. It all sounds pretty good. And then the ability, if it's a US buyer, to refinance with an SBA loan. Do you have any idea? Now, I should probably know the answer to this. How long somebody has to own the business before they can refinance with SBA? Have you had anybody do that yet?
Not yet. It usually is a couple of years because banks like to see like a 2-year track record in terms of owning the business. It might be less than that, but we haven't seen anyone doing it yet.
Yeah, I think the last time I talked to Steven Spear from e-commerce lending, it was about that as well. A couple of years you can refinance. And then when you refinance, folks, you're refinancing with an SBA loan. And it's generally a 10-year loan at, 6-7%, depending upon where interest rates are. So your ability to buy a business and be able to do this interim financing for 2 or 3 years can be mitigated pretty quickly with an SBA loan. You've just got to make sure there's enough cash flow in the business. Do you, by the way, obviously SBA does a lot of cash flow analysis, both in terms of will the business support the loan and will the personal needs of the buyer and the business support the loan? Do you do analysis like that as well?
Yeah, we take a look at the profit or at the SDE of the business and make sure that the amount that we're taking every month is not so much that the business is going to be kind of strained or that the owner is not going to take anything home. So yeah, we do that analysis.
And you, with the buyer, you do an analysis of how much they need in terms of how much they need to take out of the business to support their family?
Not really. I mean, that's up to the buyer. We just make sure that as a percentage of SDE, our debt service is not higher than 80%. So there's some spare cash flow for them to take home.
Okay. And I'm assuming that when somebody's buying, that they could get lending for the business and for inventory working capital needs as well. Yes.
Yes. So we have a special facility for that. It's usually cheaper to get growth financing or inventory financing. And we set it up like 1 year loans, interest only with a bullet at the end. So it's kind of more convenient for that type of need.
Well, that'll help with cash flow as well. If they can get a short-term loan for the inventory, it's going to leave more money for them to draw on the business. Okay. So you use the word we take. No more than 80% of SDE. That's no more? I'm assuming it's not the average. Is it often a lot less, or how does it normally work out?
It is. I mean, it actually depends. So we try to maximize our lending amount to be helpful for acquiring the business. And if you want to maximize the amount, obviously the debt service or the cash flow that we're going to take every month is going to be higher. But it's up to the buyer to decide whether they want the full loan or maybe less, so that it's not so consuming in terms of cash every month. Okay.
And how do you take it? If I use your lending services, how would I pay you every month?
So instead of having fixed installments, we have a royalty. So we take a percentage of revenues every month until we get to our target return.
Okay. So if we've got a looming potential recession, maybe revenue is going to stay flat or go down a little bit. I'm not going to have a fixed payment to you. It's going to go down or up with revenue shrinkage or growth. So if I grow like crazy, I'm going to be able to pay the loan off. Or the loan's going to be paid off sooner the more my company grows.
That's exactly how it works. Yeah.
Okay. Let's get back to when. I know that the Quiet Light folks, what we do is we'll put up there that it's pre-qualified. Some of the team is, getting really consistent at reaching out to you. When does a buyer reach out to you?
So a buyer reaches out to us, as I said, usually in their exploratory phase. So we have buyers sending us like 5 opportunities and asking about them because they're before LOI. They just want to make sure that they have access to the funding that they need for acquiring a business. So we kind of interact with them at that stage. With some other folks, though, they're kind of, they are, or with repeat clients, because in many instances we have buyers that acquire maybe 3, 4, 5 businesses throughout a period of time. they already know what we're up to and how we work, and they usually come to us once they've signed an LOI. But we're relatively new, and people just want to get acquainted with us in earlier in their process.
Okay. And your website says funding in 7 days. So I would reach out to you, or a buyer would reach out to you and share the details of a business with permission of the advisory firm, I suppose, right? You guys have to have an NDA on file. And you take a look at it, you say, yeah, this will work. This is how much we can give. We approve you, we approve the business. How long does that take? Because often it's pretty competitive if it's a great business. Is that turnaround pretty quick?
So the term sheets can be sent in 48 hours. So I guess that is good enough for sending an LOI and making sure that you get the deal. And then the closing process is a little bit slower, but we're not a bottleneck. I mean, because basically buyers want to carry out their due diligence and they have to negotiate the purchase agreement. And our closing process is much lighter than that. It usually takes a few days. So
it happens, obviously, if we sign an asset purchase agreement, the buyer and seller, and then your funding is going to happen shortly thereafter.
It happens, immediately, usually the next day or even the same day. Yeah. What
are the drawbacks to this then? I'm trying to figure it out. Is it just the cost of the funding, that 15% and that accumulates each year?
So the cost is higher than SBA, and our term is 5 years, which means that we have to take more cash flow to get repaid. And I guess that those are the main drawbacks if you look at them like that. But I guess that we built a pretty well-rounded product. We just remove the personal guarantees, which is important. We're quick, and that's the type of things that people we work with are after, and they're willing to pay the price for that. That's how it is.
Have you had any defaults yet?
No, we have a couple of, actually, that's interesting because in the current environment, we're seeing many deal flow coming to us of companies that are kind of declining, and we still can do that. It's just that we have to price them differently. And in terms of the portfolio that we have a couple of underperformers, so companies with sales declining, but none has defaulted so far. I guess that it's still a little bit early for that.
Yeah. Are you able to, and don't answer the question if you're not able to, if it's none of my business or the audience business, but how many of these transactions have you done in the last 24 months?
So we have a portfolio of 5,500 companies, and we're closing between 10 and 15 every month now. So growing quite fast.
Wow. All right. This is fascinating. I think it's incredible what you're doing. So congratulations to you as an entrepreneur in terms of launching something that is of a great need. And to the audience, if you need alternative funding, this is it. This is a great opportunity for you. Juan, how do folks reach out to you? What's the best approach to learn more about what you do?
Well, I guess that they can go to our website, www.bupos.com, and they can just start the process there by clicking on Get Funded, or contact us and schedule a call. There's also a contact section. But our website is probably the best entry point.
All right. This is great stuff, Juan. I appreciate it. Congratulations on launching a successful business and one that a lot of folks kind of need as well. And hopefully some of the folks in the audience will reach out to you soon. Appreciate your time.
Thank you, Joe. Thank you for having me here today. It was a pleasure.